The title is Linking Property Returns to Operational Business Success. I would like to add another few words, in a volatile world, because we are in a volatile world. Interest rates are at a level we haven't seen for many years, and I think that is an important addition that we have to take into account. Let me just introduce myself, and then the panel will all introduce themselves, and then we'll get into some discussion. So, Andrew Harrington, my business is AHV Associates, been around 23 years. We do M&A and capital raising, private market stuff for private companies across Europe with a focus on hospitality.
Thanks, Andrew. Hi, Kevin Byrne. I'm Head of Retirement at Octopus. I work in Octopus Real Estate, which is the real estate element of Octopus Investments. Been around for just over 20 years, about 14 billion sterling across the group in management. And yes, Octopus Energy is part of our group, but I'm always sick of explaining exactly how that fits in. But isn't it great when one of your business ideas becomes so big that you have to explain it every time you sit at the conference? So it's one point. In real estate, we've got just under 4 billion under management, split about equally between equity and debt. I sit in the equity area for retirement. I've got about 2.25 billion of GDV out in the market at the moment across 3 institutional funds, where I've got around 650 million of equity out to play on independent retirement communities in the UK.
Lauren?
Thanks, Andrew. I'm Lauren Okada-Young, and I'm responsible for European hospitality at Brookfield. We have a deep history in investing in operational real estate, and within the hospitality space, we've been quite active in the past 10 years, primarily investing in platform investments that have an operational component in addition to the real estate.
Okay, I'm Mark Quigley. I'm the Managing Director of Beaufort Capital. Beaufort's been around for about 11 years now. We were formed in the wake of the global financial crisis and initially started providing mezz finance subject to a second charge over the property to basically plug the gap between equity and debt. Since that time, we've launched a stretch senior debt fund. We're involved in every single real estate asset class that you could care to mention. And we are particularly keen to support experienced property developers all over Britain. And it's the basic stuff. Good people building good schemes in good locations. Say we've been going for 11 years now. We don't not as big a size as Kevin, but at the same time we've got we're probably doing about £500 million a year, and again it's all to development finance. So and reasonably big ticket stuff. Thank you.
Thanks, Andrew. Andrew Hunter. I'm the Chief Investment Officer for TFE Hotels. But you probably won't recognise that name, but the brand name Adina, which is our European, or it's our service apart hotel business, is how we're probably better known in Europe. We have around 75 hotels globally, based in Australia with a Singapore-based joint venture partner. And our business really grew out of real estate, and since the early 1980s, we've developed the hotel operating capability. And so I suppose we've seen the journey of how long it takes and how difficult it is to actually develop that expertise. Thank you.
Brilliant. Well, thank you very much indeed. Let me kick off with a question. Do traditional real estate investors have the skills to assess operational real estate? And the sort of underpinning of this, and apologies to people who've heard my spiel about this before, right? Which a number of people in the room have. But I come from an M&A background, and real estate is a business. It's a business with revenues and costs and profits. This happens in some cases, the revenues are fixed or index linked. Operational real estate is a business with real estate and P&L, right? And valuing P&L in a traditional M&A with a traditional M&A focus is very different from from valuing a piece of real estate with a lease to a high quality tenant, right? So the question is, given that fact, do traditional real estate investors have the skill set to be able to really understand operational real estate? Kevin?
Yeah, I mean, the answer is mixed, isn't it? I mean, some do, but clearly many don't or won't naturally have had that kind of functionality within their platforms. And so a lot of traditional real estate people, particularly where you want to do it direct, have bought teams in or built teams to look at things like build to rent, etc., with some degree of success. But I think the problem, in my view on this, is the more specialist you look at a particular area, and actually retirement and healthcare is a really good example, and actually it's probably one of our USPs at Octopus, is that you're looking at actually quite a lot of complexity around the delta between a bottom value and a top value. Now, the real estate's not really going to have a massive impact on that because you've made that choice, you've underwritten it, those bricks have gone down in a particular location. So how am I going to speed up an exit, or how am I going to maximize the value of that exit when it comes? That is going to be in how well articulated that real estate becomes by the operation. And I think that's where you do get into the world where either having that capability insourced or working with a specialist investment manager who really understands a particular market is going to really make the difference in returns. And it's not, sometimes people say to me, do you want to pay fees in a particular area? I think that's actually a red herring and it's missing the point. What you really want to do is optimize your exit value, and then you think about how you get there. So the answer is, you can do it either way, but the more specialist I think you are, the more you will be looking towards someone who can really navigate that particular sector for you.
Lauren, Brookfield is one of the biggest investors in operational real estate in the world. Would appreciate your thoughts on that.
Yeah, I think it's a really good question because it is a slightly different skill set, building an operating company or managing an operating company versus managing a long-term lease that's linked to inflation. And I think that part of the reason that we've become so prominent in operational real estate is when we look at, particularly in Europe and hospitality, most of our capital that's coming for this is more value add or opportunistic. And where yields have been in the past and interest rates, it's been very difficult to achieve these types of returns compared to a low yield environment. And so I think what we found is by investing in the real estate alone, unless you get a very good buy and good financing, you're not going to achieve those returns. So we really veered more into kind of the more operational real estate. And in doing that, I think we've looked at a lot of more nascent sectors where we think that there's an opportunity to really drive the operational improvement there. So PBSA is a good example. We have 3 active PBSA platforms across Europe where when we were investing in the space, there wasn't necessarily an established large-scale operator and owner of real estate to invest in, so we had to start building it ourselves. So part of this came about where we're looking at building businesses and building the operating company alongside developing single assets one at a time or in small portfolios. And so I think all of that to say, when you're building a company, you have to really be thinking about building the right management team, the right capabilities, and always kind of benchmarking whether it makes sense to have that internalized or if there's someone else that can do it a little bit better. So it's a debate, and we've always taken the view that there's a lot of merit in keeping the OpCo and PropCo together in one platform, but there are, as Kevin says, many different ways that this can work.
Mark, I know you don't really want to answer this question, but I'm going to push you on this. Mark is a debt provider, as he said earlier, and you're looking at it from a different perspective, right? So what are you looking for in terms of an operator which would...
Well, Andrew, I'm going to answer it by taking a step back first of all. And I've been in property finance for probably 30 years now. And back in the day, the only question we would ever ask the client is, can you build it on time? Well, let's say 2 questions, on time and on budget. That was all that anybody was interested in. Of course, the world moves on, and once you've built something, hopefully on time and hopefully on budget, what are you going to do with it next? Are you going to sell it? Are you going to refinance it? Are you going to give it to somebody else? How are you going to work it from there on in? And what we've seen over the last decade in particular, I've been doing student accommodation financing now for 25 years, but the last decade in particular, lots of different asset classes coming into play. And I think the question now is one of, do we operate it ourselves? Do we have this vertical integrated solution? Or do we outsource the operation? And regardless of which of those you choose, getting that management right, getting that proper understanding, operational costs, asset management, looking after the property. Properties have got a heartbeat, just like you or I. They have got a true heartbeat. You have got to look after them and keep them nursed in good health. And that means sinking funds, it means maintenance, it means making sure that that particular property, that particular asset is able to function to its greatest degree, and therefore you as an owner can get the greatest returns from that. Too many people seem to miss that. As I say, I'm comfortable with either model of the outsourcing or keeping it in-house, but as long as it is done correctly and done properly and professionally.
Andrew?
I think Mark's absolutely right. Looking at and the question of debt reminds me of an interesting anecdote, because if you do not get the management right, then it's value destructive. And when we actually started the business in Europe, going back 20 odd years, we were, as an apart hotel operator, in a sector, this was primarily in Germany, where it really wasn't a known commodity. And we would walk into the banks and tell them how we were going to perform and show them the way the whole model worked and everything. And they go, yeah, that's great, really sounds good. And we believe you'll do that. The problem is, if you're not there, no one else will do it. So we actually had a problem on the fact that we were an expert operator and we could add value into the real estate that was differentiated from the rest of the market. And to me, that proved that having the right skill set, having that real true expertise, and whether it's in-house or outsourced, is probably not the question. It's finding the way to get the best possible expertise to run your assets.
Interesting. But what about the valuing operational real estate? Because this is a different discipline to traditional real estate investment, right? I mean, it's got cash flows, there's volatility in the cash flows, and you can play around with preferred returns and all that sort of stuff, but it is, in essence, a very different way of looking at valuation.
Well, it isn't. I mean, I would argue that there is a change in sentiment from perhaps what we've traditionally seen as covenant to expertise.
Yeah, I agree with that.
And I think that to a large degree we've seen what Travelodge, and every time there's been a crisis, anybody who's on a lease, they're the first things that everything goes pop. And I think there's becoming a stronger and a stronger reliance on expertise, and perhaps for people who are in the pure investment position, the most important thing is to be able to understand how to assess, to be able to assess that expertise. And can I do it in-house or not? And having been working in a business that's developed this expertise long before I was here, over the last 40 odd years, and seen how long it takes to become a really truly first-class operator, I think it's something that can't be sort of taken too lightly. And I would strongly believe in looking externally for expertise is the right solution for a lot of capital.
I mean, is this the same? Obviously, we talked about hotels and healthcare and stuff like that, but other types of operational, like self-storage. We were talking about self-storage and data centers, all this sort of getting a bit off piece right now. But I mean, how important is the operator? I mean, how does it all work in terms of the operators, etc., for those other...
Sure, I think it is vital. And if you think of going back to one of the previous comments, in fact, I was approached by, it was either British Land or Land Securities 20 years ago. Said, Mark, we just want to get into the student accommodation space. We want to just write a big check and we want to buy a whole load of stock, and then we'll sit back and we'll wait for the rents to come in. That's as far removed from how student accommodation works as possible.
Completely.
As a consequence, they didn't end up doing it, but the point being that if you don't look at your individual asset class and think how best to work it. So, as you alluded to, Andrew, I recently got involved in financing a self-storage portfolio. And self-storage is an extraordinary asset class. For those who don't know, people that go for all ends of the spectrum. One person that went to visit the store, and they showed me that they had this great big space. They were an importer-exporter. They brought stuff in from Italy, they distributed it, and so they went on. That was at one end of the spectrum. The other end of the spectrum, a guy had his golf clubs there. He literally had a broom cupboard with his golf clubs in it. And he would go, every time he wanted to play golf, he'd leave the house, go and get the clubs, go and play, come back. And everybody in between. It's extraordinary. The stickiness of that income stream is remarkable. Remarkable. Data centres, there's two aspects of a data centre. There's the concept of pay as you grow. So you start off small, and as you're using more and more of the data centre's power and usage, you pay more. But there's also clawback, whereby you may end up not paying as much. The difficulty then, again, if you're, as a financier, we're expecting a certain amount of money to come through. It may not come through. So again, if you think back to the 4 quarterly rental dates where the same amount of money comes in every quarter without fail, again, it's very far removed from that. And so understanding your business model is so important. But it goes back to the same points, really. Working your asset. And similarly, if you've got a high street shop and you only sell ice cream, then the last few days will have been brilliant for you. But when it's pouring with rain, if you can only sell ice cream, you're not selling any ice cream. Having umbrellas and ice cream is a great combination. And I say that obviously flippantly, but it's the point again, you're paying for the rent on the shop, you might as well max out so that you can earn money regardless of the weather.
Yeah.
And it's really taking that and sort of elongating it to cover all of the assets and thinking through what can I do with this to make the most money, keep the operation up, make sure it's all looked after appropriately. But that's really, there's a far greater value than just what you see in bricks and mortar.
Yeah, interesting. Let's just extend the discussion a little bit. So, a number of different ways one can invest and get exposure to operational real estate with third-party management contracts, short-term or long-term, with hybrid leases with operators, sort of a bit of a risk-reward share, and ownership of operating platforms. Let's have some sort of comments on what you think about the sort of risks and rewards, or the most appropriate balance of risk and rewards with those different models. Kevin?
Yeah, and again, look, as we move away from, if you like, the post-certainty world, as I call it, about, particular yields and triple net leases, clearly we're driving for more significant returns. That's the environment we're in, yeah? So if that's a base point, that's great, but it gives me a very particular sort of orthodox return. If I want to drive up from there, then I guess I'm thinking about a management agreement and trying to take some of the upside. Look, there are some really good ways of structuring that, and that can be really appropriate, and that can work out. For me, I think, where are we at the moment, particularly in my world, I'm probably thinking, very like Lauren, in a sort of value-add mindset. And so I'm probably going to be more inclined to think about, let's sweep everything. Let's have a fully integrated strategy. Let's control the OpCo, and let's drive the real estate in through that and have an integrated piece. So when I come to think about exiting, I've got the marriage value, if you like, between those two propositions. And that's probably going to drive me the highest value. And in a world where, value add or opportunistic feels like it's a real dominant force, and if you're out raising money at the moment, you're gonna feel that. So you've got to follow that trend. And look, if you're in a nascent space as well, I mean, we're spending a lot of time looking at healthcare, retirement, housing of different sorts. Hey, it's super nascent anyway, and it needs developing. So on a risk-return basis, I feel as though I need to be up here, not down there, regardless in that sort of sector. So you put those two strands together, all of those can be relevant depending on where you sit and the maturity of the market. But for me at the moment, I'm probably at the back end, but that's just where I am today.
What about hybrid leases? Hybrid leases?
Yeah, look, again, I think they can work in specific positions. They account for variability. I mean, really, you're trying to capture the upside and manage risk for your occupier. And again, in certain asset classes, again, I can see that working. Goes back to your point originally, though, about the skill set of having to manage those. Actually, it's quite transformative from the real estate, from the investment management side, because you're straight into managing that variability and understanding the EBITDA rather than the lease payment outside of rent cover, which feels quite different than traditional world.
Yeah, interesting.
And I think to some extent, like that has a bearing on the lending availability for that type of asset. So I think, and you have a little bit of a cost of capital question. So from the real estate standpoint, you're always going to be looking at like how do I maximize the value of my real estate? And part of that is like, if it's a core, if you're core and you don't have the underwriting skill set to be like looking at EBITDA and looking at every piece of that P&L, that can become challenging. And from a lending standpoint, they may just say, a lot of lenders might look at it and say, okay, I get this minimum component, but the variable component, I mean, I'm going to take a big haircut on that because I just don't know.
Yeah, but it's interesting because the same lenders would be happy to lend to a piece of real estate, to a piece of operational real estate with full operations if the operator was a good operator.
Right.
But they just don't get the hybrid lease element. I think it's probably a
Yeah.
different part of the lender.
So you,
Sorry, Mark, you're a lender.
Can I just pick up on a point? I mentioned about the student accommodation space, and back in the day when we first started out, there was a fear across credit committees all around the land, I suspect, that what happens if the students just don't come and use this accommodation. In those days, a lot of the universities had a lot of stock themselves, and okay, it was decrepit and so on, but that's where certainly first-year students would go. But things change in time. I was always of the opinion that for me it was all about demand and supply. And I would go so far as to say that even if, I don't know, I had a lease arrangement with the University of Cambridge or Oxford itself, if my student accommodation block was going to remain unused, I'd prefer not to lend the money, even though I was protected because I had Cambridge or Oxford on the hook. For me, it was all about what is needed, who's going to use it, and so on. And we've moved a lot in time to the extent that the leases that the universities used to provide are invariably not there anymore. The model that most of us support is a direct let model where we plonk the accommodation ideally outside the front door or the back door of the university, and the kids would have to sort of hurdle over it to get into their lecture theatre. But as we know, they're a lazy bunch. They like to roll out of bed straight into the lecture theatre. So almost by dint of that, you're guaranteed to get your lettings anyway, as long as everything else is good accommodation, good amenities, and so on. But in that particular sector, the lease is a little bit of a red herring. And it's far more, does it make sense to build this here? If I take it into the hotel space, as a house, we would probably struggle to finance a hotel out in the sticks somewhere where people have got a choice and may or may not use it. If it was in London, Bristol, Edinburgh, some of the major cities, we'd feel a bit more comfortable. Alternatively, we could, so the classic sort of Premier Inn backed by Whitbread PLC, we would take great comfort from that, wherever that was built. But that's become quite a rarity for us. More for us does it make sense? Are lots of people going to be passing the doors and coming in off the street or going on Google and what have you and finding their hotels? And that's the key for us. But certainly the lease and nominations agreement from universities is a bit old hat now.
Andrew, you want to say something?
Yeah, I think there's 2 points really. One, I think it's very difficult to be innovative, exciting, disrupt the game changer if you're following a lease model, because you're constrained. You're inherently constrained. And having a more operational approach to our real estate means the opportunities are far greater. And what I think is interesting is over the last 5 years, as we've been through COVID and the interest rate crisis, what has suffered? It's been the people, and it's been the investment class that's relied upon the leases. Either they've been in situations of default, or they're caught in I think a structural problem about the investment market. I'm specifically speaking here about perhaps the German open-ended funds as probably the most prevalent example, where they're basically out the market. And that capital that usually goes into buying leases is just not there at the moment. So that model has been broken by the volatility you mentioned in the first place, and it shows that it really has some inherent structural problems. And it sort of, I think, keeps coming back to say, well, we need to get in and have the right expertise at an operational level for each different asset class, because they're not all the same, obviously. And that's going to allow us to, by far, best manage and best get value out of our real estate assets.
Yeah, it's interesting actually, because some of you know I've got a lot of contacts in America. My wife's American. I work for America. I go there a lot. Actually, in the hospitality industry, leases are very rare. Actually, if you're a great operator and you're right in the middle of New York or Chicago, wherever, you can get a lease, but it's to the operator's benefit, not the owner's benefit, right? Because they can, and they're a great operator. Elsewhere, it's management contracts, operations, etc. It's quite interesting actually, because the structural things that you spoke about are not really there in the US, or they've changed because things generally happen quicker in the US.
I think one of the challenges that we see a lot in the leased model is kind of the misalignment that naturally comes when it pertains to CapEx. And I know Mark was mentioning CapEx is something that's quite important as we think about operational real estate before, but if there's not a very clear delineation of who's responsible for what, it can become a strain in the future. And I think you see that in certain certain situations where the lease operator just has too thin of a rent coverage, doesn't have necessarily the capital to keep reinvesting, is looking to the real estate owner to do that. So that's definitely a limitation that can occur in a split operating model.
Interesting. Does anybody have any points they want to bring up? We've got 5.5 minutes to go. No? Okay.
I've got a question.
Oh, okay.
So kick people off. So I'd just like to ask, in terms of, Andrew, you made the great point in terms of having that specialism in terms of the operating partner. But we're looking at a number of investors who are investing across different asset classes. Do they have to build an operating platform for each of those different asset classes? How should they think about that? Or can they have a sort of generic living asset class?
I think even within a narrow industry like just pure hospitality, there is an immense difference. If you're a hostel versus a Park Hotel versus a Four Seasons hotel, the expertise is very different. So I think there's no generic operating part. I mean, there's obviously commonalities, but they're very specific, different skill sets.
I could see it being a sort of living brand across the top with different silos for each of these different parts. So there is definitely commonality at the top end, but as Andrew says, below that there's an awful lot needs to be done.
I've probably got some form in this territory. So in a previous life, had a number of different living assets, which actually we created our own FM platform, hard and soft. The actually commonality was about 80%. So from one extreme, we had a 320-bed backpackers hostel just down the road in Soho, with the same platform and a lot of the same tech and IT, sitting behind a premium care home brand across London and the home counties. Bedsheets are bedsheets in some ways, and FM is FM. The trick is in the last 20% and how you articulate. But that is a really good example about how you drive real value. Yeah. And actually, particularly, there's a interest there when you're looking at new living sectors, because they are quite disparate. Because having a student proposition is very subtly different to BTR, and again, single family, and you can go on a journey from one end of that spectrum to another. And your customers and their needs and how that real estate needs to perform and the capex, etc., looks quite different. So what you really need to be able to do is to be able to create something that really makes the most out of both of those. But if you start with one, it does allow you to bridge the other. You just got to work out how to do that. But in a nascent market, it gives me an awful lot of comfort to think that I might be teaming up with someone who's got the 80%. And if I'm an expert investor, I've got the 20%. And that I think is the sweet spot from my perspective.
I think you can also have a differentiation between investment, fund management, asset management, and operations, because they are and I think it's at that operational level that it perhaps gets a little bit more specialised. Well, that's not the right thing to say, but there's they're very particular skill sets depending upon asset classes.
Any other questions? Yes, sir.
So it's more of a student-specific question. I've noticed from last week there's been a lot more chat in the election around impending crisis in universities and funding. And also you've got the prospect of restrictions on students coming into the UK, coming in. Does that give you any caution or change your attitude in the medium term around investing in student accommodation?
Can I take that, Andrew?
You can.
So this is a fascinating period of our time. As I mentioned, I've been funding student accommodation for a quarter of a century. And here we are, and I'm going to be quite controversial here. I can't understand why we are solely building student accommodation for Chinese students. Now, I don't truly mean that, but I sort of do. And the reason I say that is that we are now building the biggest, the tallest, the widest, the highest, the everything, with all mod cons, and we're charging 500, 600, 700, £1,000 a week. Now, the British public either can't afford that or won't afford that. But either way, this is a real challenge. So we were chatting about this at Credit Committee recently, and we let our minds run riot and say, look, let's assume a few things happen. China invades Taiwan. The world rises up and says this is not right. The Chinese decide, right, we're going to grab our arms around all of our population from all over the world and bring them back to China. What would happen to all of these buildings that have been built, not just in London, but in all the major cities in this country, almost solely for that particular country? And we've got lots of students coming in from the likes of India, Nigeria, and so on, but they don't have the same wallet share. They're not going to be paying that sort of money. We could end up with masses of properties unlet. Now, I know that's quite a leap from where we are today, but it does mean that, and I think when I look at lending, I'm minded of the Direct Line insurance model. Direct Line decided we're not going to support all the boy racers who are 17 years of age, who are going to write off the car, and we're not going to support all the people in their 80s and 90s. We're going to just stick to that rump in the middle, 60% of the market share, and that's fine. 60% of the market share in student are the majority of people in this country who want to go and get their education, hopefully walk away with a decent degree and so on. They do not want to be paying for the equivalent of 5-star hotel accommodation. It's not to say that nobody will, but if that's all we're building these days, that is quite a challenge. So for my money, I would like to stick to the knitting, sensible schemes, sensible locations, at a sensible price.
I'm afraid we're out of time. Thank you. Thank you.